What's going on, everyone? Happy Friday. It's September 4th, and I want to get everyone a really quick update on mortgage rates because the Fed cut rates by 0.5% 2 weeks ago, and since then we've seen rates start to move for the worse, and the last 3 days have been really bad, unfortunately, for mortgage rates. So we want to explain why that's going on and what you can do about it. Whether you're looking to purchase or refinance, of course I want to make sure you make the most confident and educated decisions possible. And there's two different outlooks on this. If you're looking to buy a house, I have one idea, and if you're looking to refinance, I have another. So we're going to go through all that, but most importantly, I want to show you the data and the reason that we're seeing mortgage rates start to move for the worse. First of all, why didn't the Fed rate cut have any impact on mortgage rates? Well, when the Fed cut rates on September 18th, the market actually moved ever so slightly for the worse. Why would that happen? Because they had already adjusted, the mortgage markets had already adjusted at the very beginning of August because Jerome Powell came out and said, hey, guess what? It's time for rate cuts in September. So the market reacted to the news. It didn't wait for the actual event. Let me show you. Okay, so as always, we are looking at mortgage bonds trading. And remember, up is good, down is bad. It means rates are getting better when mortgage bonds go up. And here is the end of July and the beginning of August. And this is when Jerome Powell said it's time for rate cuts in September. So the market reacted to it based on his announcement, and then the mortgage rate stayed flat for the whole month of August. We were sitting at the best levels we've really seen in the last 2 years for the entire month of August with very little movement, which was fantastic. And then you can see that at the beginning of September, in anticipation for the Fed meeting, we got a little bit better. And then it sat flat, waiting for them to do something. And then on September 18, Jerome Powell did exactly what he said he was going to do, and they cut the Fed rate by 0.5%. And the mortgage rates stayed flat as a result. There was no impact. That's because we knew it was coming. It had already happened, right? So if he had said, hey, I'm not cutting rates, just kidding, you would have seen mortgage rates go back up dramatically almost overnight. But since then, what we've seen is mortgage rates just ever so slightly sliding. I look for patterns a lot, and you'll see that I found this pattern where it's like we were playing pinball between these two parallel lines, and we were sliding for the worse as that happened. Now, let me show you why I thought this was going to be the best rates we would see. Because at the end of 2022, in the beginning of 2023, this is the exact same place we were. You see, mortgage rates tend to have a history of repeating themselves. And if we had think of this ceiling that I'm showing you right here as a floor for mortgage rates. If we couldn't break through that ceiling to have mortgage rates go lower back then, I had a feeling it would happen again, and sure enough, it did. And that's why for those of you that have been trying to encourage to refinance right now, assuming there's a very, very short-term benefit, because I do think you'll refinance again, on the refinance side of things, there's not a right answer right now or a wrong answer. For some people, if you're saving a substantial amount of money by refinancing, a short-term or temporary refinance, I'm calling it, can make sense, but we want to see a very short-term break-even point. If you don't have a very short-term break-even point, it's worth waiting till later. And that's why we analyze this for every single person individually. Now, let me get back to the rates. So if we zoom back into the last 3 months and what's going on right now, what happened today? Well, today the jobs report came out and they said they added 430,000 jobs to the economy, which makes it sound like we're in a great place. We're adding jobs. It's fantastic. What the headlines never say is that none of these jobs are full-time, and 230,000 of the jobs reported in this report are for 16 to 19-year-olds. I remember where I was working when I was 16. I would fill up my gas tank with my paycheck and then hope that it would last for the next 2 weeks until I got paid again. I could barely afford gas in my car at 16 years old. I didn't have to worry about a mortgage, school, or anything else. So what kind of jobs are those? What kind of jobs do 16 to 19-year-olds typically take? The headline sounds great, 430,000 jobs, but the reality is they're not that great, and what normally happens is we'll see things start to level off or come back after the initial reaction. So the reaction to the headline is that mortgage rates have gotten worse because it sounds like we're in a better economy, and that makes the stock market rally. Money moves out of bonds and into stocks. It's typically what we see in these moments. And what you can see here, if I draw a line across, is where we've landed. As of right now, we are sitting back to basically where we were at the end of August. So we lost all of the benefit of mortgage rates that we'd gotten through the month of September. Now, if you're looking to buy a home, what do, right? Is all hope lost? No, it's not. Remember, when you're looking at buying a house, I always say don't worry about the rate. And the reason I say don't worry about the rate is because if rates improve, you can always refinance. And there's a lot of people doing that right now. They bought in the 7s, they're refinancing to the 6s. I've had some people refinance into the 5s. So there's a benefit to refinancing. Of course, what matters is making sure the monthly payment is affordable when you buy the house. I would much rather have you get into a payment that is affordable, and by affordable, maybe it's like you're stretched a little bit, but we can still live the life the way we want to, knowing that there's going to be an opportunity to improve it later. I always use myself as an example. I bought my house in 2021. I'm quote unquote so lucky to have gotten the interest rate I got. but no one's coming to save me. You see, I have an interest rate of 2.625 on a 30-year fixed, which is amazing, but my payment was at my absolute max, if not slightly above, because I had to fight everybody else for the same house. And there's no opportunity for me to refinance. And that's kind of the benefit. If you have to stretch your budget a little bit, again, you want to make sure you can live your life the way you want to live it. If you do have to stretch, that you're going to have benefit of bettering your payments in the future, because rates will most likely come down. So your worst case scenario, your current payment is kind of the worst case scenario. My current payment is the forever scenario unless I sell the house, which I'll never do. So anyways, I hope this gives you a little bit more information on what's going on with mortgage rates so that you can decide what you should do if you want to refinance, what you should do if you're going to buy a house. And if you have questions of, Sean, how does this impact me personally? Thanks for the overview, but what should I do personally? Reach out to me anytime. I'm always a resource to help you. And again, our goal is to ensure that you always have the best mortgage possible and that you make the most confident, educated decisions, not based on sales and gimmicks of the mortgage industry or the real estate industry, but on data and analytics. So let me know how I can help. Thank you so much. Have a wonderful weekend. I'll talk to you soon. Cheers.